As active traders, we rely on technical indicators to help us provide context to the current price. If we say something is priced at $10, we don't know if that's good or bad. That really depends on what it's relative to. What was the price yesterday? Was the price $100 or was the price $1? Because that dramatically changes whether or not $10 is a good thing or a bad thing. So a stock chart will give us the historical price, and then the technical indicators help provide context so we can understand the current price relative to where it has been. Now, one of my favorite technical indicators are moving averages. So in this episode, I'm going to describe the moving averages that I use in my own trading. I'm going to show you real examples of how well respected these moving averages are. And I want you to know that whether you're trading futures, Forex, cryptocurrency, or you're trading stock, moving averages can be used because they are part of the universal language of technical analysis. The reason these moving averages are so well respected is because traders all around the world see them and understand what they are communicating. Just in the same way that a traffic light works the same pretty much anywhere in the world. Red means stop, green means go. It's a respected international language for the road. And so these technical indicators are the respected international language of the financial markets. And once you learn to recognize those buy and sell signals, that for you will be laying the foundation to a path forward with success. Okay, so we're gonna go ahead and jump into this chart. This is a candlestick chart, and I'm about to show you something that's gonna blow your mind. This is really cool. Okay, so the price is going sideways here, and then all of a sudden it starts to squeeze and pull away. Now, this is exactly what I look for. As an active trader, I trade volatility. I look for things that are moving. I don't try to guess what's going to move. I don't buy something that's not already moving. I look for something that's starting to pull away. And as a momentum trader, I'm looking to buy the first pullback to ride the next wave higher. Because the market moves in waves. You have that first move up, which you can't really predict. You never really know, when something is going to have news or when it's going to move up. But we can buy the first pullback. And that's what I love to do. So on this chart right here, we get this first move up, we get the pullback, and this is typically where I would be a buyer. But we are missing one very important indicator on this chart. We don't have the correct moving average. I took it off because I want to show you how important it is. Now I'm going to turn it back on and I want you to watch this. Look at that. Look at that moving average. This moving average right here is a very well-respected level of resistance. When the price is below it, it's resistance coming back up. When the price is above it, it'll be support coming back down. This is called the 200 period moving average. And as the price comes up, it ran right into it. It pulled back, but it came right into it again. A third time, pulls back, comes up a fourth time, a fifth time. It's not able to break through this level of resistance. So if you didn't have that on your chart, if you didn't see that indicator, well, you wouldn't have that context. You wouldn't have that perspective. And you might have taken a trade right in this area and lost money because you were missing out on a very clear sell signal. This is a sell signal for taking profit, for shorting. It's a clear indicator to not get in the chart. But if you don't see it, well, you're trading without all the information. So the way these moving averages are calculated is, and I'll put it on the whiteboard here just so you can see, the 200 period moving average is calculated by taking the closing price of the last 200 periods. So the word period is important because it's relative to what time frame you're looking at. So this chart right here shows as a 1D, which means it's a 1-day chart. Each one of these candlesticks represents 1 day of time. So that means a 200 period moving average represents the average closing price over the last 200 candles, the last 200 days. So this is a long moving average. It takes a lot of days to form, and it's very well respected. When the price is below, well, unfortunately, this moving average is resistance. When the price is above, the moving average is support. So in this case here, I'm using the 200 period moving average. And something that's important to know is that moving averages come in two basic varieties. You have a simple moving average and you have an exponential moving average. Simple and exponential. A simple moving average simply calculates the average price over the last 200 closing days. So the closing price over the last 200 days. It's that simple. That's all it is. An exponential moving average is a little bit different. What an exponential moving average does is it weights the more recent price, the more recent closing prices more heavily than the closing price from 199 and 200 candles ago. And the reason it does that is because if you were just taking the average price over 200 periods, you would get a little bit more of a slow moving line, even as the price starts to pull away. But if the price is pulling away quickly, an exponential moving average, in contrast, is gonna hug the price a little bit closer because it's weighing these recent closes more heavily than the closing prices back here. So while the math on this is not important for you to understand, what is relevant is that an EMA, also known as exponential moving average, is going to be more popular among active traders because it moves a little bit faster and it's more responsive. An SMA, which is a simple moving average, moves a little slower and is not quite as popular among active traders. However, what I can tell you is that a lot of traders will use the simple moving average. And this is true with a lot of beginner traders who aren't as well educated in the differences between exponential and simple. So if we go back to our the rules of the road analogy, this would be as if most drivers stop on a red light, but there's a handful of drivers out there that will also stop if they see a blue light. So that means as an active trader, because there are people that respect the SMA and will stop when they see it, you sort of have to use both and you have to be able to recognize both. So then what I do on my chart is I actually have both. I have the SMA as a dotted line here, and I have the EMA as the solid line. And I only do this on my daily chart, and I do it because the daily chart is such a well-respected time frame. So many people check the daily chart before considering whether or not they're going to take a trade. So I want to make sure, if I happen to see that the price is running into resistance here, it's important for me to be aware of the fact that it's probably because of the simple moving average. And it may indicate that there are a lot of beginner traders that are invested and purchasing shares of whatever it is that I'm trading here because they're seeing this simple moving average as a possible resistance level. So that'll be more common and better respected on meme stocks. Meme stocks being, your stocks like GameStop, GME, AMC, etc. So these are the meme stocks. All right. These stocks are going to have more respect for SMAs and a little less for EMAs because they're traded very actively by non-professional traders. So this could be extremely confusing as a driver on the road if there were literally sort of two sets of rules for different drivers because we're all driving on the same road. And so you can imagine as an active trader, it is a little confusing that you have different indicators that are respected by some groups of traders and then other indicators that are respected by other groups of traders. So when we're looking at a chart, how do we know which one will be respected? I have them both up, and it's very clear to see in this case that the EMA is the one that is being respected. It's possible that I could pull up a chart on something else and we would see that, on this one, it seems like it's the SMA that's being respected a little bit more. And so in that case, I might notice that and then pay more attention to that moving average. However, for the daily chart, these are the moving averages that I use. I'm using the 200 period EMA, the 200 SMA. Those are critical. And this one is in the dotted line, whereas this one is in solid. Both are in purple. And then I'm using the 20 EMA. This is in solid and it's in blue. And I'm using the 9 EMA, also in solid, and this is in gray. All right. So these are the moving averages that I'm using on my daily chart. So all daily charts will have these 4 moving averages on them. So when I'm looking at the chart, you can see each one of them here. We've got the SMA in dotted. We've got the EMA in solid for the 200. And then down here, we have our gray 9-period exponential moving average. And you see here, this is a good example of how quickly this sort of crept back up as the price moved higher. And that's because it's an exponential moving average. It's going to adjust more quickly. And then we have the 20-period exponential moving average down here in blue. And this is one that I actually use a lot more on my intraday timeframes, to be honest, a lot less on the daily chart. But to keep things simple, I use the same indicators on all timeframes, with the exception of the SMA. I don't use that on my intraday timeframes. Okay, so now we've got a good picture, and I hope you're excited by seeing the potential of how well this is respected. So let me show you something else. We're going to back out here, and I'm going to show you what I call multi-timeframe alignment. So this is my trading platform as I'm using it every single day. I've got my scanners on the left-hand side right here. These are offered at Warrior Trading. They're called Day Trade Dash, your day trade dashboard. I've got my scanners for top gainers. I've got my small cap momentum scanners, and I've got my news window right here. And then, of course, this is where we have chat rooms and so on and so forth. When it comes to charts, I always have 4 time frames open. I have the daily, I have the 5-minute, I have the 1 minute, and I have a 10-second chart. Now, you can see on each of these, I have moving averages. So let's look at the 5-minute moving average just for a moment. Okay, so this is our 5-minute moving average, our 5-minute time frame. So we've got our 5-minute chart here. And on this one, you can see I have the 200, I've got the 20, and I've got the 9. Those are my 3 moving averages. Now, I also have the volume weighted average price right here in orange. This is an average, but it's factoring in volume in addition to price. And so this is actually showing us the average price of a stock over the course of the day, factoring in the volume, the amount of volume that took place at the different prices. So this is one of the most respected intraday indicators, but it is not available as a daily indicator. It's only available for intraday. Now, when it comes to intraday, this volume weighted average price shows us pretty much the equilibrium. It shows us literally the average price of the index of whatever this instrument is, whether it's a stock or a commodity. It shows the average price over the course of a day. If the price is above, I would say this is in control by the bulls. If the price is below, it's in control by the bears. So if it's below volume weighted average price, we're weak. If we're above, then we're strong. Naturally, the same is more or less true with the 200 period moving average. If the price goes below it, it's obviously a sign of weakness. Now, if we watch this chart here, we can see that the price comes down and breaks below the 200. It tries to get above it, but it's not able to hold. And if you notice at the open, the price pops up, runs right into that level, and then sells off. It pops back up, it comes back up, runs into that level, and sells off. So how do you think your trading would be if you didn't have this at all? Would there be places where you're buying without realizing that there's a stop sign? And I think the answer is yes. And that's why it's so important to have these indicators turned on for your charts. That way you are fully informed when you're considering taking a trade. You might say, oh, look, this broke over volume weighted average price. Yes, but we have a little problem here, and it's a 200 moving average. It's in the way. This is the 200 on a 5-minute time frame. So it's taking the average closing price over the last 200 5-minute candles. Okay. Now, something else that's interesting on this chart is that on the day that we had this big move right here, the price, as you can see, had to break over the 200 moving average, right? It crossed that very critical level of resistance. So pre-market, when the news first came out, I pulled up the chart, and the first thing I saw was, uh-oh, we've got the 200 moving average here, and it's right at $3 and about 30 cents. That's really close. So when I pulled up this very fast time frame, which is our 10-second chart, let's see, this usually goes back 2 days. I'm not sure if I'm going to be able to get to the beginning of this move. Let's see if I got it. Okay. So we're going to go back here. Nope. So right. So it's going back exactly 2 days. So we're going to look at the 1 minute chart. Okay, that's fine. So we're going to look at the 1 minute chart, and we're going to see where this first ran into a little bit of resistance at about $3. So the price starts to move up. So we're going to watch this here. The price moves up right in this area. And one of the things that I noticed was, well, this right here, $3.30 is our 200 moving average. So when we came up here, we ran into 330 and we dropped down. And initially I was worried about whether or not it was going to be able to hold over that level. And what I looked at was the volume. I said, well, geez, look at this. We've got 300,000 shares of volume in this first 1 minute candle. This is a huge amount of volume. We have a news catalyst. That gives us a reason for the price to continue higher. Yes, we did just hit a little bit of resistance here. And when this first came up to this level, one of the things I saw were sellers on the level 2 at $3.30. So the sellers were already there. What that told me was that there were people perhaps who had been holding this for a few days, maybe from way back here, who were saying, I want to sell this when it comes up to resistance at the 200 moving average, which is at about $3.30. And that would have been logical. It keeps tapping that level and selling off, tapping and selling off, tapping and selling off. So if you had accumulated during this area, where would you logically be taking profit? Right up here, absolutely. And if you're a short seller, you may think, you know what, I'm going to sell it against this level and then cover it as it comes back down. But what happened in this case is there was enough strength because the catalyst was so strong that it was able to break through that 200 moving average. So, let's see. So we broke through the 200 right here. And then once we were above that level, all I knew is that as long as it can hold above 330, we're golden. We're in great shape for a move higher. So watch, it pushes higher here. It goes up to a high of 364. It pulls back, and this gives us a micro pullback right here, which is our first really solid entry. Then it pushes even higher. It goes up to 388. It pulls back. It squeezes up to 420. It hits a high of 430. Red candle on higher volume. So a little bit of a caution flag there. Higher volume red candle, but as you can see at the open, this thing is able to push even higher. And it actually kept grinding all day long. Now, for those of you who are interested in the strategy that I'm trading, I focus on trading micro pullbacks at the beginning of the move. So right down there, that's the micro pullback. That's the place where I'm a buyer. So if you check down in the description, there'll be a link at the very top of the description, and there'll be a link pinned to the top of the comments that gives you a link where you can download my micro pullback strategy in PDF form. You could download it, you could print it out, you could put it on your desk, and you could start using it sort of as a reference as you're looking at these opportunities in real time. My job and my goal is that I'm able to help provide you with financial literacy so you become empowered to be able to capitalize on these opportunities, because these are happening every single day. We see it again and again and again. So if you're missing it, to me, it's just because you haven't yet learned the language of the financial markets. You haven't learned to recognize these buy and sell signals, because they're as clear as can be once your eye has been trained. Okay, so on the 1 minute chart, we're way above the 200 moving average. The 200 moving average, we're not even really factoring that in, but we are looking at the 9 moving average and we're looking at the 20. So when we start to trade on shorter time frames, this is these shorter term indicators are what I rely on. Something that I did early on in my career, and you may find it helpful, is I actually went into, I went into the style guide on this, and I changed the thickness just to make it like impossible for me not to see it. And one of the things that I will always do is when a stock is trending higher like this, I'm looking to buy dips off of this moving average. So I like to buy dips off the 9 moving average, because you can see when we're in a strong trend, we pull back to the 9, we move higher. We pull back to the 9, we move higher. We pull back to the 9, we move higher. Now, if we break the 9, then I'm not going to buy right there, because we broke. We broke that level. But if we're holding above and we're coming down just finding support at that level, that's a place that I'm really interested. Now, if we break the 9 moving average, it's the average price over the last 9 candles, then the next logical area that I look at for support is the 20 moving average. Now, the 20 moving average, I will sometimes buy dips off this level. One of the things that I'll tell you is that if the price breaks below the 200 and it holds below it, now this broke it and then came right back above, but if it holds below the 200, often that can spell kind of the end of the trend as things start to shift. So in this area here, and this is especially true when you step out on longer time frames, this is going a little bit sideways. When we're in a period of sideways, we can jump up and down, sort of above and below. But something to notice are when you see these big crossovers. So here, the 9 moving average crossed below the 20. So that's called a moving average crossover. If you look down here, this indicator is also showing a crossover. Because moving averages are so important, one of the indicators that I like to use is called the MACD. MACD, and I'll spell it out so you know, MACD. This stands for Moving Average Convergence Divergence Indicator. And it's an oscillating indicator, as you can see on the chart right down here. And the way this works is, if we actually look at the settings of the MACD, what it's taking is the 12 moving average and the 26 moving average, and the signal is the 9 period moving average. And so what it's doing is it's showing you when the moving averages are diverging, which is that they're moving apart, and when they're converging, which is when they're coming back together. So when the moving averages are diverging, the price is almost always moving up when they're diverging to the positive, as they are here. When they're converging and coming together, the price is going into a period of consolidation. And when they cross over like this, usually the short-term trend is reversing. So here we get a reversal in the trend and we're getting this pullback. As part of my micro pullback strategy, I always want to be focusing on trading when the MACD is above the signal line. So this is our signal line right here, and I want to see that we're above the signal line. There's different ways that you can color this. You could turn the histogram on or off. Some people will do that. You turn off the histogram. You could change the signal line. You could even change this to a histogram. So you could sort of change the coloring of this a little bit if you want. I've done a couple different things over the years where I'll do this. I'll make this bright green, and then I'll make this red here. So I'm only going to trade when I can see green. If I can't see green, I'm not going to trade this. All right, so that's too thick. So I'll do it like that, and maybe we'll make the red just a little bit thicker. So we'll go like this. So in other words, let's just imagine only trading when I see green on this histogram. Now, if I see green on this histogram, what this means is that the moving averages are diverging, they're moving apart, and no doubt the price is going to be above the 9 exponential moving average, right? We're going to get, when we get crossovers, that's when the price drops below. So that means we would only have traded right until about here, right? Actually cut it off right about here. So that's the window we would have traded. Now, there was a small window here where you could have considered it, but it's a very small window. This is a very small window. And to be honest, in this area, it's kind of grinding. It's not super clean. Now you've got another small window here that you could trade it. Then it's a little bit choppy, You've got some small windows in this area, but this is a little bit later in the afternoon. So it begins here and continues until about here. Then it closes and then it opens again here and goes to here. So this is a technical indicator that I use. And for me, I found it incredibly helpful in helping me avoid false breakouts. See this candle right here? See, well, I wouldn't have been wanting to trade this here because the moving averages had already converged. So this is the area I would have been trading. This area, nope, not interested. So this, for me, in a sense, is showing me the windows where I can consider trading. And if that window's closed, I don't want to consider it. Today we had VVPR, which put in a pretty nice move. So I'll show you this one, and I'll show you the moving averages on it. So on this one right here, over the last day, we had some really nice volatility. So we'll go back to the beginning of the move, and I'll just show you this as an example. And let's back this up here again. So on this one, on VVPR, when I first pulled up this chart, so yesterday, by the way, we had over 120 million shares of volume, ton of volume. We had breaking news yesterday, and the news came out at I think it was 8:15 a.m. So I pull up the chart, and the first thing I saw, once again, 200 moving average. Shoot, it's right there. And I do see the EMA and the SMA are pretty close together. This, unlike the other chart that we were looking at, this doesn't have that really recent price action of several tests of the 200. So I can't tell for sure whether or not the EMA or the SMA is being respected more. When I look back on the chart, it's a little hard to tell. So either way, I know that both of them are right around this $3 area. So I know that that's going to be my first level of resistance. So now I flipped my intraday time frame. This is down here, so I can always see a little snapshot of it. But I switched to my intraday time frame. So we'll pull up our 10-second chart. On the 10-second chart, I am concerned that we may see resistance around $3. Okay, so let's watch this. So what first happens is the news comes out and the price squeezes from about $1.50 all the way up to $3. And it moved pretty fast, but right into the 200 moving average. That was resistance. So I didn't buy it right here. I didn't buy it here because I knew this was resistance. And that saved me because other traders bought right here thinking it was going to keep going. And look at this flush. It came all the way back down to 2. And it did it on pretty high selling volume. I think short sellers were confident and shorted this with a stop at the 200 moving average. So it ends up going sideways for a few minutes and kind of slowly curling back up. And as I saw this volume coming back in, I started to think that I should watch this to see if it has the strength to break the 200, just the way the other chart had on the previous day. Okay, so these were two very similar charts back to back. So as I'm watching it right here, I'm thinking to myself, this looks like a buy for the break of 290. And I actually take that trade. It's going to be right here. I take the trade for the break at 290, but look what happens. We hit 305 and it drops down again. So actually on my first trade right there, I got in and I got stopped out and I had a small loss. And I thought, boy, all right, well, that 200 moving average is resistance and we're right at it here. I'm looking at the 10-second chart, but I know that this is the price where that moving average is on the daily. So I know that we have resistance here. Now, there are some people that would overlay the daily moving averages on top of your 10 seconds, so you would see them on the same time frame. And you could do that, but then you have to find a different coloring system so you don't confuse the 10-second 200 with the daily 200. I think it gets a little confusing. I think it's easier just to remember that we've got a daily level at $3. But then it comes back up here and I got back in at 305. I said it's coming back up again. I think we're going to get a break. And on this one, it pushes up to 329, to 337, 365, up to 420. Now we've got micro pullbacks. So that was a micro pullback right there. This was a micro pullback right here. Now we top out a little bit at about 420, and then we break up to 440. All right. We pull back again. We dip back down. And this, what's happening right here? Right here, our moving averages, we're getting the drop back down, and this is where we had the moving average crossover. So let's see. I don't usually use the MACD on the 10-second chart, so I'm just going to go back and show this to you on the 1 minute. All right, so on the 1 minute chart right here, we've got this move from $1.50 approximately all the way up to a high of $5.60. And the window was open this whole time. It closed right about here as we pulled back. So this was the window where I made the most money. This was a really nice window. This was great. There was nothing to complain about here. This was really solid. Now it pulls back a little bit. It comes back up. Now some people bought right here. But what I was looking at was the position of the MACD. I was like, I'm not sure about that because this is negative right now. This is pulled back for a little bit too long. I then said, let me check multi-time frame alignment. Let me check the 5-minute time frame. So the 5-minute time frame at that moment, what it was showing was that the price was very extended. And it was extended relative to what? The support of our 9 exponential moving average. I need to wait for the price to come down closer to the 9 or for the 9 to come up closer to the price before taking the next trade. And watch what happens. Price comes down right to the 9. It breaks below it for a moment. And then off of support, it rallies again. So this is the area to be a buyer, especially when you've already had a big move. Now, when you've had a big move and you're getting a micro pullback, like what we had right in here, this is when we have a frenzy of volume, a lot of buying, and this is a fine place to take a micro pullback trade, and this is when we can get some really nice parabolic moves. And I've seen times where price went from $2 to $5 to $10 to $15 to $20 to $25 to $30. And it's super extended on the 5-minute chart, but we keep getting these little micro pullbacks and it keeps going higher. So that'll happen if we have a really strong catalyst, and I am happy to trade that. I have no complaints about that. But once we start to pull back and we're going sideways, if the price is floating here up way above support, it usually has a high likelihood of doing a false breakout and dropping. It needs to come down and test and hold support. And if it does, then we look for the rally back up. So this rallied back up, but then we had another false breakout right here. Now, if we look at that false breakout and we pull up our 1 minute chart, what we'll see is that once again, the MACD was against the trade. So this moving average convergence divergence indicator was telling me not to be in this trade. So see how this has gone, this is going negative right here. You can see it's going negative. And then where's that false breakout? Right there. So no, you shouldn't be getting caught in that. But a lot of traders, if they're not using the right indicators, they're not seeing the market with all the available information. And it's true that there are more technical indicators than you could possibly put on a chart. I mean, there are thousands and thousands. There are an infinite number of combinations of indicators you could use, but use the ones that are most respected. So, you know, even with traffic, the rules of traffic, you may not know every single sign. There's all these little signs, you know, like construction and deer crossing and, you know, hedgehog crossing. I mean, who knows? There's like a million different signs. You may not know every single sign, but you better know the stop sign, right? You better know what a red light, a green light mean. You have to know at least the basics. And these indicators, the moving averages, the 9, the 20, the 200, and then using the MACD, these are standard indicators that everyone should be using. And if you're not using these, you really are going to find yourself making unnecessary mistakes. And trading is hard enough without making unnecessary mistakes. So anyways, so the MACD is against the trade here. Now the price action looked fine. If you didn't have MACD on your chart, you know, if you sort of hid this, you might have thought, well, the price is holding up here, you know, it's okay. But what I would say is that we went sideways for too long. We'd already seen a history of a couple false breakouts, high volume on red candles, high volume on red candles, red candles, red candles, red candles, red candles. High volume red candles indicates that there's a lot of selling. And that's the importance of using the volume as an indicator. The volume and seeing that volume profile is what's telling me, you know, what's going on here. Now, some traders use, I mean, there's, like I said, there's a million indicators you can use. I won't overcomplicate it for right now. So just to stay focused on the moving averages. All right, so we got that rejection there. This popped up right here. And then we go sideways. And then what happened on this morning is look at the position of the 200 moving average. We end up coming down to the 200. We bounce off it right there. That's our low. And then we move higher. So could we put an arrow here and say, buy here? We probably could, right? Buy me. I'm at the 200. This is support. As long as this holds, we should be in great shape. All right. So it ends up holding. It goes sideways and curls back up, and then it pulls back again. Okay, so now this time it dips back down. It goes right to the 200. It bounces back up. It comes down a second time. It breaks below it. It comes back above. It comes back and it can't get above. And this is so classic that you'll have this price action where you'll have the 200 moving average. So let me just draw this here. You'll have the 200 moving average like this, and you'll have the price, you know, let's just say, for instance, the price is moving up and it kind of hesitates here for a second. It ends up pulling back for a moment, just for a moment. Then it comes back up and it breaks through this level. So we have a nice breakthrough resistance here. And then we come back down and it has to hold. So it breaks above, it comes back down, it proves it can hold. And if it can hold, then this is where a lot of people are going to begin buying with a stop just below right there. So the same is true when we break to the downside. So right in here, if we got zoomed in, what we would see, and we'll go ahead and zoom it in here just to get really dialed in on this. What we see is that the price came down and bounced and springs back up. It kind of comes down again and comes back up. It comes down a third time, and this time it actually breaks below that critical level of support. It comes back up, it goes lower. Now it comes back and it cannot get above that level and it sells off. Tries again, can't get above that level, can't get above it, sells off. Tries one more time, it gets above it. And now sellers probably try to push it back down. And can it hold? It does. and then it rallies. You get that little rally back up. And all of this is happening right around this moving average. If you didn't, and this is also sort of a inverted head and shoulders pattern. So if you didn't have this moving average here, well, you wouldn't have understood why we're having such a struggle in this area. Okay, so then this morning, this ends up pulling back. It's going sideways. And then we get above that 200 moving average right here at about 7 a.m. And then all of a sudden we start to pull away, right? We get this nice move here up to 620, up to 640, pull back up to 7, pull back up to 8. And we ended up getting a move here all the way up to nearly $10 a share. Now, if we look at our moving averages again, 200, it stays well above the 200 for this entire move until it comes down right here and then finally breaks it right here. We look at our moving averages, or our moving average convergence divergence indicator, and what we'll see is that we had the window open, closed for a moment, was open again, closed for a moment, was open again, closed, and was open, and was open. So if we look at the areas where we were open, let's see, we were open basically for this whole stretch here, we were open, we closed for a moment, and then we were open again until here. Then it closed for a second, and then it opened again as we curled back up. And this is an area where we bounced off of that 20 moving average. So that 20 moving average held a support. We didn't have a full moving average crossover. In fact, we had, it looks like a crossover here. We almost had a crossover here. The price did go below the 20, but we didn't cross. And then we finally had a clear crossover here. So just moving average crossovers are something to pay attention to, so much so that there are some traders who use moving average crossovers as part of a trading strategy. It's not a great strategy all by itself, because by the time the moving averages have crossed over, usually it's already pretty clear that the trend is shifting. You know, if you were waiting to sell or short till this crossover here, you know, it's well off the highs. This crossover was okay, but in any case, I'm not a fan of trading just based on crossovers, but it is something that I pay attention to. So this ends up pulling back. It's below volume weighted average price, which is our orange line. We're below the 200 again. And at this point, you know, it's not in play. There's no trades to be had. So I think success as a trader, it's very important that you're, of course, using the right indicators. It's also important that you're focusing on trading aggressively when the window is open. The window, so to speak, the way I think of it is, you know, each day there's a window of opportunity. And on each stock, there's a window. And again, it doesn't matter if you're trading a currency pair, you're trading futures, but on each instrument you're trading, there's a window of opportunity when it's going to be clean, where you're going to see these big moves. And usually it's early in the move. It's early in the move because usually that's when you sort of get this first reaction from a catalyst. There's a news event that brings in a lot of volume, that brings in a lot of traders. And initially, short sellers and even sellers are like, well, let me just hold off for a second. Let's see how high this thing wants to go, right? Let's not, you know, sell too soon. Let's see what it wants to do. So that first move can be very, very clean. You get that first push higher, you get a couple little micro pullbacks, and then that's where I'm making usually the most money. And on stocks that go parabolic, that go from 5 to 8 to 10 to 12 to 14 to 16, a lot of times they basically go straight up and they don't look back. In fact, the only opportunity to trade those is to be buying, you know, these brief little micro pullbacks as they shoot higher. And this is going to be on like a 10-second chart. So again, you could download the micro pullback strategy PDF that's pinned down in the description and in the top comments. But this is the place where I want to be a buyer. And what I would encourage you to do is print out a lot of these charts as examples so you can have them as a reference point. Because one of the things that we're doing as traders is we're actually visualizing the future. What we're doing is we're looking at a pattern, but we only see half the pattern, right? So if you're looking at this, you're looking at just at this point, you know, you've got a couple green candles and you don't see this yet. So you've got just a couple of the green candles. You got your first red candle, and you now have to visualize what's going to happen next. Is this just going to go, you know, all the way back down, or is it going to rally back up? And so we visualize this based on recognizing patterns and based on using the technical indicators that are available to us. It's not a guarantee. There is no sure thing in trading, but we use these indicators, we use these patterns to help us improve our statistics and our probability of making money, of being right. And the trader who's able to predict the future the best will be the ones who make the most money. So on these micro pullbacks, I'm buying these little dips, I'm buying these little dips, and then next thing you know, the price is up, 200, 300, 400%. This VVPR yesterday, between 2 days, went up 573%. 573% from the low down here all the way to up here. But would it have made sense to trade it all day long, every single day? No. There were windows here where there was a lot of opportunity to make money. And then there were areas or windows, so to speak, where you probably would have lost money if you were trading it too much. So using your moving average convergence divergence indicator, this is a great way of just sort of base level. Is this the front side of the move? Is this the area I should be focusing, or, is this choppy? So I look for when the moving average is above the signal line to trade aggressively. And I want to be really aggressive on the front side of the move. And then when it starts getting choppy, when we see that moving average crossover, I'm just going to step back. I'm going to sit. I'm going to be patient. I'm going to wait. Now, there's a lot of other traders that are going to keep trading. They're going to be in the trenches. They're going to be trading every single candle. I see some traders out there who will literally trade every single candle, buying and selling. And I think you do a lot better if you focused on being aggressive during the candles that are really strong and green and just sitting on the sidelines completely when it gets choppy. So if you found this episode helpful, I hope you hit that thumbs up. I hope you subscribe to the channel for more episodes on trading strategy just like this. And I want to make sure you download my micro pullback strategy PDF. It's pinned in the top of the comments and the link is in the description. And as always, I'll remind you that trading is risky. My results aren't typical, so manage your risk, take it slow, and I'll see you for the next upload real soon.